Purchase order financing for small business, what's best for me? Call 888-653-0124 today or click the link in the description to learn more. We all know there are tons of different financing options available to purchase inventory items for our small businesses. Unfortunately, not all of them work well for everyone. Are you looking for financing options for your small business? If yes, then you should consider purchasing order financing. This type of financing allows businesses to purchase inventory from suppliers at a discount price. Purchase order financing, POF, is a form of credit extended by banks or other financial institutions to companies who want to purchase goods or services. PO financing works by allowing a company to pay for its purchases using the proceeds of their next sale. The seller receives payment before they ship the goods. Why purchase orders are important for small businesses. Purchasing is one of the most important functions of any business. It is a process where you buy goods from different suppliers and then sell them at your own price. In this way, you get paid for the products you bought and provide a service to your customers. The best part of purchasing is that it allows you to save money because you do not have to pay for the product until you actually receive it. This means that you can order whatever you want without having to worry about paying for it first. However, there are many things you should consider before you buy. Here are some of the reasons you should always use purchase orders when you run a business. 1. You can avoid late payments. If you do not have a good payment system, you might find yourself in trouble if you fail to make payments on time. When you purchase something, you usually set up a payment plan so that you can pay for it later. If you do not follow this procedure, you could end up losing a lot of money. For example, if you miss a few payments, you could lose your supplier's trust and they might decide to stop selling to you. Therefore, you should always take care of your payments. 2. You can reduce inventory costs. When you buy products, you usually keep them in stock. When you do not have enough inventory, you cannot sell anything to your customers. This means that you will have to spend more money on storing the products than you would have spent on buying them. You will also have to pay for storage fees. Therefore, you should never forget to check how much inventory you have before making a purchase. 3. You can control your expenses. You may think that you can just buy what you want whenever you want, but you should be careful with that. As we mentioned earlier, you should always consider how much inventory you have and how much you still have to pay for it. Once you reach the limit of your inventory, you can no longer buy new inventory. Therefore, try to manage your spending as much as possible. 4. You can increase sales. Having too many products sitting around in your warehouse does not help you sell more. Instead, focus on getting rid of excess inventory. You can do this by offering discounts on old items or giving away free samples. Your customers will appreciate these offers and they will be more likely to buy from you again. When to use purchase orders. The most common reasons for using purchase order software are: 1. To reduce cost, by automating processes and reducing manual errors. 2. To increase efficiency, by automating and standardizing processes. 3. To improve accuracy, by providing a clear audit trail. 4. To ensure compliance, by ensuring that all suppliers follow standard procedures. 5. To provide visibility into inventory levels, by allowing managers to see what stock they have available. How to manage cash flow in your business. Cash flow management is a process that helps you plan and control how much money you spend and when you make payments. It also helps you track your spending so you know where you stand financially at any point in time. The key to managing your cash flow effectively is to set up regular monthly budgets. This way, you'll always know exactly what you're spending and when you need to pay bills. You should also keep track of your expenses throughout the month. This will help you identify areas where you can save money. Budgets are used to determine how much money you want to spend during a certain period. For example, if you're planning to buy a new car this year, you might use the budgeting method to figure out how much you want to spend on gas, insurance, maintenance, etc. Once you've determined how much you want to allocate to each expense category, you can then decide which expenses to cut from your budget. You can also use a spreadsheet to keep track of your expenses. Simply enter the amount spent on each item into the appropriate cells. If you don't have access to a computer, you can use a paper ledger to record your expenses. How to manage payment terms. Payment terms are defined as the amount of money you will pay for your product or service before delivery. It includes the price, shipping costs, taxes, discounts, etc. The most common types of payment terms are fixed term, fixed price, variable term, variable price, and installment payments. 1. Fixed term. This type of payment term is when the customer agrees to pay the full cost of the product or service at once. 1. Fixed term means the customer pays the total cost of the product or services at one time. The advantage of this type of payment term is that there is no risk involved because the cost of the product or the service is known from the beginning. However, if the product or service is sold online, then there is no way to know how much the customer will spend until she makes his/her purchase. 1. Variable term. Variable term means the customer agrees to pay for the product or service based on the value of the product or service received. 1. For example, if the customer purchases a car for $50,000, then the customer will pay $5,000 per month. 1. Here, the customer will receive the car after paying the entire amount. 1. If the customer receives less than what was agreed upon, then the customer will have to make up the difference. 2. Installment payments. Installment payments mean the customer agrees to make several smaller payments throughout the life of the contract. 2. This type of payment term allows the customer to pay the entire amount at one time, but the customer must pay a certain percentage of the total cost every month. 2. For example, if a customer buys a house for $500,000, then the buyer would pay $25,000 up front and then pay $2,500 per month. How to negotiate with vendors. Negotiation is the process of agreeing on a price, quantity, delivery date, etc., when buying goods from another party. It is used in many situations, such as buying a car, renting a room, hiring a service provider, etc. The negotiation process comprises two parties, buyers and sellers, who want to agree. Here, we are talking about negotiating with vendors. The primary goal of negotiation is to come up with a mutually beneficial solution. A good negotiator should know how to listen, how to ask questions, how to express his/her ideas, and how to make concessions. In order to negotiate effectively, one must understand what she wants and why. To do so, you must first identify your goals. You should define the problem you are trying to solve and then find out if there is any way to achieve them. If there is no way to achieve these goals, consider alternatives. Once you have identified your goals, think about what you will give up in order to achieve them. This is called negotiating leverage. Leverage refers to the power you hold over the other party. For example, if you will pay $100 per month for a product, you have leverage because you can buy the product at that price. If you are only willing to pay $50 per month for the same product, you don't have leverage. You should never start negotiations without knowing what you will offer and what you will accept. Once you have defined your goals, try to figure out what the other party will accept. It is also important for you to determine what you will compromise on, and what you are not willing to compromise on. Your next step is to communicate your goals and expectations to the other party. Make sure that you are clear about what you want and what you expect. Don't just tell the other person what you want, show him/her what you want. How to find out if you qualify for purchase order financing for your business needs. If you want to know whether you qualify for purchase order financing, then you should first determine what kind of business you run. Do you sell goods or services? Are you a manufacturer or distributor? Is your company looking to expand into new markets? Once you know what kind of business you're running, you'll be able to find out if you qualify for purchase order finance. Purchase order funding is available to small businesses that sell their own products or provide services to other businesses. The terms vary depending on the size of the business. One option is a line of credit, which provides a set limit based on your sales volume. Another option is a revolving credit account, which will allow you to draw funds against future orders. Call 888-653-0124 today or click the link in the description to learn more.